Hey, how's it going, everyone? Zachary Jensen here, managing partner of TaxWise Financial Services, where we're empowering small business owners with tailored tax strategies to reduce taxes on business and real estate investments, which drive growth and financial success. Today, I wanted to go over a tax plan we did for a client a few months ago. This client was looking for tax savings, as so many are towards the end of the year in their business. And rather than just kind of keeping this little tax plan to ourselves, we thought we would create a more generic version. So he's not going to have his name on blast. So, you don't need to worry about that. For other clients to potentially think about and say, well, that would make sense for my business. So would love to dive deep into this tax plan, show you guys how it all works and why it's so effective. So we call it the six-figure savings tax plan. So this allows a lot of business owners to slash taxes by six figures or more using this structure. And when I say six figures of taxes, we have to keep in mind that if you're earning a lot of income, you're going to have a lot of taxes, and all the savings in here are not necessarily guaranteed, but they are more or less going to save someone with that income significant amount on taxes. So just with that kind of disclaimer out of the way, let's dive into it. So we've got this map here that we've created, which is pretty nice. Now, I know you guys are seeing all these arrows. It's not as complicated as it looks, really. We just have an operating company, then we have a holding company, which gets some consulting income, which is just income that we earned over here. And it's paid out to our C Corp. And then we can do things like run a C Corp payroll, pay our health insurance, which in C Corps allows us to deduct health insurance dollar for dollar, which is nice. We also have the self-directed 401k, which depending on if you're married or not, allows you to put away anywhere from 60 to 100,000 plus in retirement accounts. Then we've got the operating company profits, the operating company payroll, and it all just flows to you. And then once you get the money, we're not just going to go to blow it on vacation and travel. No, we're going to invest it wisely because that's what your accountant wants you to do. And we're going to put it in your backdoor Roth, your real estate investments, and then 529 plans if you have kids. So in this introduction here, we just go over, hey, we understand a lot of people aren't thinking about this all day, so that's why we're doing it for you. The part one is the LLC taxed as the S corporation. Why are we doing the S corp? Well, S corp essentially allows us to avoid a lot of self-employment tax when taking distributions. There's also some great benefits here, which are outlined in the guide. I'll just quickly skim over it because this video is meant to be more of a highlight reel to help you reading the guide go over it and understand, look, is this for me? Is this not for me? So let's just continue on here. But usually we do want to elect the business as an S Corp if we're talking about the type of profile I was talking about earlier. And then we've got a few different deductions here, right? We've got the home office deduction. A lot of people know about that one. We got the salary and wages, pretty obvious. Rent, business vehicles. This one's less obvious. And this one really depends on your situation. A lot of real estate bros out there will be writing off their G-Wagons and all this kind of stuff. So we're not suggesting to go that crazy, but it is possible to do something similar to that. And obviously your equipment and advertising expenses, business travel expenses, any sort of professional services, including us, the accounting firm. So those are the deductions we're going to be taking under the S Corp. When we get to the C Corp here, we're really thinking about, okay, well, because of the double taxation, we want to make sure that we're taking as many write-offs as possible because that income should not be coming out, right? A lot of people say to us, well, Zach, what about the C Corp's double taxation? And I always remind them, look, that's only if you take the money out. So we don't want to take the money out and distribute it to us after paying it because we're going to have the S Corp get taxed and then the C Corp get taxed. This is a separate company. This is a consulting kind of holding company you create for yourself. And then you run your self-directed 401k through it. You run your health insurance and payroll to yourself through it, which a lot of people ask us, why do we have two different payrolls? It's just cleaner like that. I know that sounds counterintuitive. Why is it clean to have two payrolls? But for the type of benefits we're talking about with the employee matching, we really want to have a payroll in the C Corp and then a payroll in the S Corp. If you did this in your S Corp, you would be required to have all your employees get a retirement plan. And usually that's very expensive for this type of person. Again, it really depends on who you are, but for this type of person, and to clarify, high earner who owns a small business. Once you start getting to like 5 million, 6 million, 7 million in revenue, those sizes have better different strategies. But this is really for the high earner who is anywhere between, let's say, 300,000 and $1 million a year in income, and they have a business that's doing, let's call it 4 or 5 million in revenue, or less. So, okay, now that we've gotten that clarification out of the way, let's go to part 3, how to invest your remaining profits. So once you've done kind of the waterfall strategy of going all maxing out the self-employed 401k, maxing out your health insurance here, and then of course paying yourself on payroll, we want to move over to maxing out your Roth IRAs, your real estate, and your 529 plan. And then here's where things get interesting with the real estate. We can actually go a step further and try to get real estate professional status. This one is very, very powerful. I'm sure a lot of you guys have heard about it. Real estate professional status allows us to take what is passive income for a regular investor and turn it into active income. And when it's active income, we can also take active losses. And when we do something called a cost segregation study, where we accelerate all the depreciation created from real estate up into years closer to now, rather than doing a 27.5 year or 39-year straight line depreciation schedule, we can create significant losses in the current year and allow you to write off significant amounts of depreciation against W-2 income. So that's a very powerful strategy used by W-2 earners, but we can do the same here as well. And then in the guide, I go over all the various qualifications for real estate professional. I'll just quickly list them off. We want to make sure we have 750 hours of material participation in real estate. So we need to be in an active trader business. So if you have a W-2, it's not going to work. Now we're on payroll here for our own company. So we do have a W-2, so it's not going to work. So this would be for someone who has a spouse that's, let's say, either not working or working very part-time in a 1099 capacity, and they want to get more involved in the real estate to create this tax saving strategy. So 750 hours, and then you must also spend 100 hours or more than anyone else, or 500 hours material participating in your own rental activities. So this one is kind of confusing for a lot of people. It was confusing for me at first when I read this, but it's essentially 2 tests. We have the 750 hours test, which is like, hey, are you involved in real estate as far as the professional activities go? So broker, investor, that also counts, right? So you can almost double dip these hours, right? These 500 hours into these hours, but these hours can't go into these hours. It's kind of an awkward system. Like if you're a real estate agent, your 750 hours of being a real estate agent has nothing to do with your 500 hours of materially participating in your rental activities, right? So actually working on the rentals. That's how I think about it. So this test, this 500 hours or 100 hours more than anyone else, is just about the rental itself. So your apartment building, your 5-plex, your commercial building, that's all these hours are about. The 750 hours test is something completely different. But in the 750 hours test, you can also be an investor, and it can double dip, quote unquote. And this is all under section 469. For those crazy enough to be interested in this stuff, they can go and read that. All right. And then we talk a bit about 529 plans. Those are great for kids. At the end here, we really just go over how it all gets tied together, right? So we've got the S Corp feeding income to various sources, to you via payroll, to your C Corp via consulting fee, and then from the consulting, excuse me, from the C Corp to the consultant, you. So yeah, this tax plan has worked very well for a lot of people, and it saved people a lot of money. Yeah, hopefully we can do the same for you. And if you have any questions, feel free to email me, Zach, Z-A-C-K, at taxwisecorp.com, or you can go over to taxwisecorp.com/contact and fill out the web form there. Yeah, hopefully we'll hear from you, and hopefully we can save you some money with a similar plan. Thank you so much for watching, and I'll hope to see you in the next video.